everyone, welcome to Pit Stops the Podium, the RevPartners podcast, where we talk to execs who have competed and won, taking our companies from high growth to high scale. My name is Brandon Tollison. I serve as the co-founder and CEO of RevPartners, and I'm delighted to have with me today David Hornik for this episode of Pit Stops the Podium. Welcome, David.
Hey, thanks for having me.
Absolutely. Well, for those who may not know who David is the founding partner of Lobby Capital. And David, this is an opportunity for you to give a little bit of background on who Lobby Capital is. So maybe a kind of elevator pitch, but more importantly, what I'd love to do is kind of the origin story of how you got to Lobby Capital. So what led you to start it?
Yeah, I mean, that could be an hour in its own. But suffice it to say, I grew up in a house with a dad who was a very early computer scientist, had computers in my basement. I went off to college. I got a degree in computer music, which qualified me to go to law school. I went to law school and was a lawyer for a period of time. And I returned to Silicon Valley in 1997 when the internet was exploding. And I was a lawyer representing startups, and I loved it. I thought startups were amazing. And I was completely addicted, and I was going to board meetings and helping companies to succeed in a really amazing period of time in technology. And after one of those board meetings, I heard the fateful words, "Hey, David, have you ever thought about the venture business?" And it was from a guy named Dave Marquardt, who was one of the most successful venture investors ever. He was the only private investor in Microsoft and sat on that board for 33 years. And he had sat in board meetings where I had, shot off my mouth about things that had nothing to do with the law, like growth and sales. And so he was very kind. And we had a 4-month courtship before he said, "Why don't you join us?" So I joined this firm, August Capital, in 2000. And for 20 years was investing at August in early stage software companies. I came in when August was investing its third fund. And so August 3, 4, 5, 6, 7 in 20 years. And when we finished investing August 7, I sat down with my partner, Eric, and said, "So are we raising August 8 or do we want to do something different?" And we decided that we had built this amazing conference called the Lobby Conference. It's this sort of unconference where really thoughtful execs come together for a few days and sit around on beanbag chairs and talk about the stuff that matters to them. And that conference is called the Lobby Conference. And we thought, you know what? Let's just lean into the fact that our community comes together at these events to talk about how to be successful and help each other be successful. Let's call it Lobby Capital. So we raised a new fund as Lobby Capital. So I am a first-time fund raiser, and we're busy investing in it in late seed and Series A software companies. And it's in many ways the same as I've been doing forever, which is the most fun part.
That's great. Well, I'm familiar with the Lobby Conference. It's an amazing network and amazing community. And I think you are humble enough not to share some of the wins you've had, and maybe we'll get into that as we get into the big idea. But David, before we kind of get into things that you look for when you think about investments, we do have a tradition here at Pit Stops the Podium, and that's to get to know our guests outside of work, because at the end of the day, we're human beings, not human doers. You have a very interesting background in terms of music and law, but what are some things that you enjoy, passions, hobbies, interests that our audience should know?
Yeah, I mean, I have kind of 3 outside of the office, foci, if you will. I am an art fanatic. My wife and I are just lovers of contemporary art, and we spend a huge amount of time enjoying art. And that's given me the opportunity to do things I would have never guessed. I sit on the board of the Smithsonian American Art Museum, which is amazing. I helped launch a new museum in San Francisco called the ICASF, where my wife and I both are on that board. So I spent a lot of time with art, and just think artists are amazing that they can create such beauty. And so that's fantastic.
Who's the artist behind you?
Yeah, this is an artist named Zé Palito, who was from Brazil. And my wife got to know Zé's work literally on Instagram. And we came to know Zé and are huge fans. And his career is just exploding because his work is just so beautiful. So the other one of the other legs of the stool is that I spend a lot of time in LGBTQ rights. I've been on the board of GLAAD, one of the leading gay rights and queer rights organizations in the country, for a lot of years. I was on the board for 7 years. I timed off the board, and then I rejoined the board. So I really think that gay rights are LGBTQAI rights are a really important thing in the civil rights path of this country and every country. And so I devote a lot of time and energy to that. And the last thing is I'm fanatical about Broadway. I think Broadway is just an amazing art form. And I've had the really fun fortune to be able to be a teeny tiny producer in a bunch of great Broadway shows. The most recent, if you haven't seen it, is called Kimberly Akimbo. And it's on Broadway now. And I think it's going to win the Best Musical Tony because it's so amazingly it's both hilariously funny and completely heartbreaking. And it's hard to do both of those things. So
how did you get into that?
Yeah. I mean, a little bit of it is in two paths. My oldest son is an aspiring Broadway composer. And so he and I, sort of obsessed over that art form in lots of ways. He's now in his late 20s and working and running around Broadway. So that's exciting.
Yeah.
And the other is that I became very good friends with the composer of Avenue Q, a guy named Jeff Marks, who's just an incredibly brilliant composer and a lovely character. And I had the great fortune of investing in his show, Avenue Q, and then got to know other folks. And I just realized, if you reach out to people about the shows that you see that you think are amazing, they're very happy to let you help be part of that path. And so over the last handful of years, I've invested in 8 amazing shows, and it's been really fun. They've been quite varied from plays like Slave Play and The Inheritance to musicals like Hadestown and Kimberly Akimbo Now and Avenue Q and others. So it's really fun, and I'm just glad that I get an opportunity to help bring this stuff to the planet because it should exist.
Yeah. Well, we may have to do another podcast on the parallels between B2B investing and investing in plays and the themes that you've learned.
And art, right? I don't invest in art. I love art. I buy it. I don't like the market, the economic market. But it's a super interesting topic. So let's do that.
I love that. You would educate me quite a bit. Well, you're going to educate me regardless, but that's a whole new world. Well, let's transition a little bit into kind of meat today, David. So first of all, thank you for sharing the passions that you have. It's always fun to get to know our guests outside of work because that really kind of shows really who you are. But let's get into, kind of the day-to-day from a work perspective. You've had the fortune of seeing some home runs. I'm sure you've seen some failures too, but there's signals of success and failure along the road. And certainly with what's been going on in the market, there is a heightened emphasis on making sure you understand what are the right things, right signals, and what to avoid. So let's start here. Let's start with the trends maybe that you're seeing just in general. When you think of the macro view of what's going on in the VC space and software, from your perspective, explain what you're seeing and what people should be mindful of.
Well, what I'm seeing is the worst fundraising environment in almost forever. And I hate to be, there's no other way to put it. I just think it's
Let's start with a positive.
Yeah, right. Let's start with the good part. The good part is, there is a good part because I've seen this, right? I saw it 2000, a really challenged market. We saw again in 2008, a very challenged market. We're now marching through it in 2023. It's not like this is the first time it's happened. It's just that by and large, it's the first time any given entrepreneur has experienced it. And at the moment, it's the first time a whole lot of investors have experienced it. And so in those instances, 2 things are true. Cash is king and revenue is the greatest thing on the planet Earth, right? Because there's nothing better than not needing to raise money. And the best way to not need to raise money is make more than you spend. So it's a very challenging time, and you need to have a very clear picture of how are you going to get to cash positive, and how is each dollar going to turn into more dollars. And I think that the venture community is very focused on that in ways that we have not been at all for the last more than a decade. So it's really off-putting because 2 years ago, if you said, I'm really focused on profitability, the investor would say, why? That's not in any way interesting. All you should be focused on is how can you grow faster.
Yeah, like rationalization is a curse word.
Yeah, no, exactly. I don't want to hear that. I just want you to grow. That's not true anymore. And it also used to be that, oh, I have X amount of money in the bank, but I can always raise more money. That's not true at all anymore. So that's the biggest challenge. Now, here's the good news. The good news is, and I invest in very early stage companies, right? I fund companies when they're 10 people or 12 people, they're early, they're demonstrating product market fit, they're selling their first stuff. And so you've got nowhere to go but up, right? It's not a market problem. Yeah. It's, can you convince someone to do this thing problem? And that, in a lot of ways, is better in a market like this because there's just not a lot of competition. It's not like there are a million people trying everything. It's not a lot of noise. The people who are doing it are really focused because you have to really mean it to build a company in this environment. It's not fun. It's hard. But the companies, I think all of my great companies have come out of tough times like this. When I funded Splunk, it was 3 guys with a really interesting idea. And I didn't say like, oh, this is a terrible time to raise money and you'll never raise it. I said, wow, if you could build a search engine at the time for log files, now for machine data, if you could build a search engine for machine data, that'd be amazing. And the conversation, could you do it? And then they said, yeah, we can do it. Took a long time to build it. And then it was like, okay, can you sell it? But by the time we were really selling and getting out there, the market had come around, right? And our big challenge was to get public before Facebook. That was our goal. Before Facebook sucks every dollar out of the market, let's get Splunk public. And that went fantastically. And I'd say that each of my companies has ridden through these challenging markets, and those markets have made them stronger and better. So it is hard, and there will be companies that go out of business, mine included. But in the long run, it's just a bump. It's not your whole story.
Yeah, I think it's easy to get kind of tunnel vision, narrow focus. But to your point, nothing's new under the sun, and these things happen. And let's dive in a little bit into what you were just describing, though, because cash is king, yes. And that's really impacting a lot of these, mature and young companies, candidly. I mean, mature, you're seeing layoffs every day. There seems to be a headline. And some of these early stage companies just don't have the runway to survive. But when you're looking at that early stage, like Series A, to your point, even using the Splunk, the Splunk example, at that point, it is more of an idea. You're making a bet on an idea or the entrepreneur or the person versus, hey, we have this growth engine and we're going after it. I mean, sometimes that's true, but it seems like more often than not, it's more of a thesis and it's the people. And so how do you, as you're starting to kind of, I don't know if you're making adjustments, but how is that changing the way you think through that, hey, I'm going to write a check or I'm not for that type of company?
Yeah. I mean, Splunk was a bit of an outlier for me. I typically do Series A investments. So Fastly is a good example. Fastly had gone out, they'd raised some seed money. They said, we're going to build this, content distribution engine that will be differentiated. And by the time they came to me, they had a dozen great customers, including Twitter, which was spending a lot of money. And so I was able to then call the customers and say, why are you using this thing? Why, it's very risky to work with a startup, in particular on your content. Why would you use this? And they would tell me the stories of how differentiated it was, why it was that they couldn't use the Akamais of this world to do the things they wanted to do. They really only could use Fastly. And after a set of those conversations, then the question I have to ask is, are there more of these, right? Is Twitter somehow unique? Is Wikia unique? Or is it, in fact, a perfect example of what's happening in the rest of the market? And I'm going to invest money, and they're going to then build a sales team and build a marketing engine and find a lot more Twitters. And, so I have some signal, and it just depends. When I invested in Bill.com, they had some customers, but it wasn't growing quickly. And so that was more a bet on, I think this is an important area. I think that over time, small businesses will understand that it would be much better to pay your bills electronically than trying to write checks, right? So in each instance, you kind of look at where they are, and you look at the product, and you look at how it's different, and you look at how they're selling it, and you say, I bet you if I were to give you $10 million, $7 million, $12 million, whatever it is, that you could then go demonstrate that this is replicable, that you can go from a dozen customers to hundreds of customers, that as a consumer business, you can go from thousands and tens of thousands of users to millions of users, right? That's my bet. And so you have some signal, but then you have to extrapolate from there. And that's kind of the fun part. And, most of the time it turns out it doesn't work out. That's just how venture is, certainly Series A venture. But some of the time, you put money in and it turns out that there are lots of customers and they're very happy to pay and you build a big business.
Yeah. So if I heard you right, you got to believe in the idea. You have to see, you have to see the opportunity within the market. And it sounds like there's an element of, hey, I'm going to do some interviewing and understand why the customers that they do have, what's the value? And then is there a path to, not necessarily to scale, because I think it's too early, but is there a path to replicate that use case with with whatever product or differentiation they have?
100%. I mean, if I were a later stage investor, I never have this metric. But to my mind, there's basically a single metric that will answer, does this product have product market fit? And that is net revenue retention, right? Yeah. At the end of the day, it may not solve everything, but if you have more than 100% net revenue retention, then you have a product that is compelling to a company. They are spending more in year 2 than they spent in year 1.
Yeah. Yeah.
That's kind of the whole story.
Yeah. Yamini Rangan, the CEO of HubSpot, I mean, that is the metric. And it's kind of, now we're seeing that over and over, especially your point about cash and revenue. That is the North Star metric at this point in time. And
think about it, right? You get to day 1 of the year, and let's say you're a little-ish company and you made $10 million last year, and you want to grow even 100%. I'm going to grow 100%. If you have no net revenue retention above 100%, then you have to grow $10 million the next year in brand new business. If you have 150% net revenue retention, you've delivered half of the growth you need for that next year. You've got $15 million in the bank. Now you have to deliver that next 5, and the following year you're at 30 before you've even opened the door.
Yeah.
That's amazing. That's such a gift.
What do you think? This is probably too broad of a question, but if you're to think through, hey, I agree, net revenue retention is the North Star metric. What are, outside of the product thing? Well, those are things people can control, but from a sales and marketing perspective, how does that CMO, how does that VP of sales, how do they make that the rally cry for the organization? Or for their department, rather.
Well, here's why it is the North Star metric, but here's how you can completely screw it up, right? Which is, it's of course true that net revenue retention is unbelievably valuable. And for sure, you can wildly influence your sales team to impact net revenue retention by compensating them for dollars grown.
Yeah.
And if you're a salesperson, it is way easier most of the time to get more dollars out of folks who already believe in your product than it is to get new people to believe in your product. Yeah. So salespeople love that. Great. You want to compensate me for getting this $100,000 customer to be a $150,000 customer? I'll do that every day of the week.
Yeah.
The problem is that if you do not grow new customers while you're growing your net old customers, you'll run out. It's not possible, right? At some point, you can't increase 50% year over year on customers that have been doing that for 4 years, 5 years, 6 years. Yeah. So you need to incent your salespeople to bring in new customers as much as you need some system to make sure that you have happy customers who are spending more money. And I think that what I have seen more often than not is when you over-index towards net revenue retention, it ends up messing up the equation because you don't have enough top of funnel and you don't have enough net new. So even though I think net revenue retention is the metric, I think that the focus of any sales team has to be new customers. And net revenue retention is product-driven growth, right? It has to be that the product is so amazing that you use it more, right? People who downloaded Splunk and were using it as sysops to figure out what was going on when their systems were going down, used it more because suddenly someone who was doing compliance said, how do you know that information? So, I have this thing called Splunk. Well, can I use it? Yeah, sure, use it. It wasn't, I'm going to call up and say, hey, compliance people, your sysops people are using Splunk. Because if you said to a compliance person, check out what your sysops people are using, they'd say, well, I don't care what they're using. But when you discovered that they had this magic data that you didn't have, you were like, woo, how'd you get that?
Yeah.
So every great company has a little bit of that, where you use it and then you realize, oh, I should use this some more. But what you really need is a lot more of those customers having that realization, not driving the customers you have to spend more money.
Yeah, I think it makes sense. It's like, hey, that's to your point, the Northside metric, like we're all rallied around this is what we need to be accomplishing. But at the same time, depending on where you are in the department, there are things that you still need to be measured on and be held accountable for, because then you will get completely distracted. One of the things that we've looked at is, do we create hey, sales team, you do have a responsibility for retention, because if you are closing the wrong type of deals just to get to your number, we are going to see churn. So there is an element of you need to be held accountable for that. But to your point, you're going to be heavily skewed towards bookings because we need to continue to generate that revenue to allow us to have on the back end that increase.
And by the way, cost of acquisition is also hugely important, right? It turns out if you could get amazing net revenue retention, but if a customer doesn't pay back for 3 years, okay, great. You hold on to them for 10 years. They're profitable customers, but you know how much money you need to be able to get that flywheel going? And right now, that's not a thing that's happening. So, number 2 metric is time to payback. Yeah. Right. If you have a day one payback and a 200% net revenue retention, you're the greatest business in the history of time, and I'll fund you every day of the week.
Hey, anybody that has that profile, reach out to David. He will be happy to write you a check.
Hornik@lobby.vc. Email me, Hornik@lobby.vc. That is the business I want to fund.
Well, David, thank you for coming on board. I really enjoyed the conversation. Kind of our final lap question I think you kind of just alluded to it, but if we do have companies and or individuals that want to engage with you or with Lobby, what is the next step they can take?
Yeah, feel free to email me. I have made the foolish but I believe correct decision that I answer every email I get. And if you have something you're wrestling through, or you have an amazing company you want to have me take a look at, just email me.
Well, David, thanks for your insights. We really do appreciate your contribution, and have a great weekend.
Thanks so much. Loved it.